In addition to depreciation, some kinds of expenses are set up as assets and amortized over a period of years. In most instances, amortization is calculated using the straight-line basis. Like depreciation, the annual expense is booked to reflect assigning the cost over a number of years. However, rather than setting up a negative asset account, each year's expense is usually deducted from the asset value on the balance sheet. Amortization is applied to general expenses that are paid in advance but applied over several years. The formula for determining monthly amortization is like this: the total cost divided by the months to amortize. Let's see an example. Your company paid a 36-month insurance premium in March. This expense applies to a 3-year period, so recording the entire expense in the current year is not accurate. Instead, the payment is set up as a prepaid asset on the balance sheet. If the total paid is $3,852, the entry looks like this. The proper amount to be expensed is equal to 1/36 per month. In the first year, this period covers March through December, or 10 months. Using the information, calculate the amortization per year for each period. Let's see the calculations on a spreadsheet. Here is the example. We have 4 years, total cost month to amortize each year. Because in the first year the period covers March through December, or 10 months, the current year's expense is 10/36 of the total, or here we have the total cost multiplied by the months to amortize divided by 36, and we will receive 1070. The second and third year will each equal 12/36, 1/3 of the total, and the formulas are the same. Total cost divided by 12, multiplied by 12 divided by 36. And that's why we have the same amounts here. And the fourth year we will recognize the remaining 2 months of the total. So here we have the total cost multiplied by 2 divided by 36, or $214. At the end of the 36 months, the prepaid asset value will be 0. So the sum of these amounts should equal, as you can see here, to this one. A second type of amortization is intended not to properly recognize general expenses, but to write off certain kinds of costs that apply over many years. This is more like the depreciation of capital assets and is applied to tangible costs like research and development or the cost of acquiring a lease. In these instances, the cost is amortized over the applicable period determined by accounting rules. Amortization can also be applied to intangible assets, items shown on the balance sheet but containing no physical value, goodwill, going concern value, brand value, or covenants not to compete. These valuations often are determined at the time of a merger or acquisition and booked according to how a contract is worded. In these instances, the amortization booked as expense each year reduces the value of the intangible asset until it reaches 0.